Hello, hello. All right, in this video, I just want to talk a bit about the risk to reward ratio, right? I think most people, most newbie traders, think that high RR trades are better, basically. But are they really better? Most of them think so, right? Because you're risking small and you make so much more. You can compound your account quicker. You don't have to win as much. But I think most people, most newbie traders, misunderstand what it takes to catch these high RR trades. It's not as simple as it sounds, and it's not necessarily an indication of how good of a trader you are. Right? It's very possible to be a trader that averages a one RR trade or even negative R trades and still be very successful. So there are a couple of factors that tie into that, which I'll cover, and then I'll show you on the chart what I mean. Uh, for people who don't know what risk to reward is, basically when you get in a position, it's how much you're risking in terms of how much profit you are aiming for, right? So a one RR trade would be you're risking one to make one. So whatever you're risking, if you're risking 1%, your target is 1%. So if you get stopped out, you lose a percent. And if you succeed in your trade and it goes as planned, you make 1% as well, right? So if you're in a trade and it goes to your target, you make a percent. If you risk a percent, right? Whatever amount you risk, you'd make that amount. But if you get stopped out, price comes down, hits your stop loss, you lose that amount that you risked. Okay, so a 1 RR trade would look like that. 2 RR trade would look like that. A 3 RR trade would look like that. 4, 5, 6, 7, and a 10 would look like that, right? So you'd have to get in there, and price would basically not be able to have any drawdown, and it goes to your target. Now, if you go online, and if you've been around social media, Instagram, Twitter, YouTube, Facebook groups, you see these people with screenshots of their um mega RR trades, right? They caught 1 to 20, or some people both catching a 1 to 50, even 1 to 100. That's what it would look like. It would look like you got in there, virtually no drawdown, and price goes all the way to there. I mean, you'd have to be so precise, right? So let's go through what it would take and just understanding it a little bit better, right? So the first thing to consider is your personality and your experience, right? So trading is about finding a model or creating a system that developing a system that vibes with your personality. Some people can tolerate more risk. Some are more risk averse. Some prefer to be in the charts more often, and some do not. Maybe they don't have the time as well. And this all relates to the type of R's you should be risk to reward, you should be targeting, and your experience ties into that as well. If you're inexperienced, you likely do not have a back-tested model, and you probably don't really know what you're doing, right? It takes experience to know the markets better, to know your different systems better, and to know yourself better as well. So that takes time and it takes study. Second point is understanding the odds, right? Like, the long position I put on here, 100 RR trades. It's not about being precise. Um, it's very difficult to be that precise. And setups like that don't happen very often. You won't be able to catch every single top and bottom. Sometimes the market is doing nothing, right? And sometimes you're wrong. and that's fine. Losing is part of trading. Protecting your capital, losing little, and making more. That's how you survive as a trader, not being someone who knows every single thing the market's going to do, right? And point three relates to that: patience and effort. So, patience comes in the form of waiting for those kind of setups to appear. And the only way to catch such high RR trades ever is to have a solid top-down analysis with a higher time frame point of interest for taking a trade and writing that all the way down. Because the only way you're going to get such a high RR if you manage to catch a trade that yields a lot of pips. You can't do that on a 5 pip trade, a 10 pip target trade. It's simply not possible. The spread will kill you. Anyone that shows that on online of screenshots of just doing this on TradingView without actually taking the trade and proving it is most likely lying. Furthermore, it takes a lot of effort, right? You'd have to be there to catch that trade because you won't have much time, because you'd have to catch it on the lower time frame um, once the higher time frame gets there. So you'd have to be in front of the charts a lot. You can't decide when the market moves. You'd have to be there, and you'd have to be fortunate enough to catch that trade at, at at that exact moment, which is quite rare. And anyway, the fourth point is flexibility and adaptation, right? So what do I mean? Let's say you had a rule: 1 to 4 RR trade minimum. You'd have to be fortunate enough to always have your trade work out without ever coming back on you, right? So, you get in, starts moving your way, it's almost to your target, oops, starts reversing, and it fails, right? You were almost at your target. Hello. Okay. So you were almost at your target, but then you lost out. You didn't take any profits, um, etc. So you took a loss for nothing. Most professional traders will take partials, and that would affect your RR. And that's fine. As traders, you're here to make smart decisions. You're here to protect your capital, not show off. This amazing lucky trade that you caught. Because the whole point is to do it consistently over and over again over a long period of time, over your entire career, and aiming just to get lucky, to be the sniper over and over again, it's not realistic. You can be pretty pretty damn precise if you know what you're doing, especially if you learn things like ICT's concepts. But I don't think even ICT himself is able or even tries to do such amazing feats every single time, because the market does not offer that. And I'll show you that on the chart now. So let me make that visible. Let me delete this. The daily chart. Let's go into 5 minute, for example. Okay. So let's say you had a 4RR minimum and you wanted to take a trade here because you anticipated going higher above this level, right? So you see it moving to the upside. All right, you get in on the market buy. What do most people do? They put their stops at the low. And you say, okay, I'm targeting let's say 1 to 3, right? Static. Price comes up and it comes down and you take a loss. Let's say you didn't move your stop to break even or even half. You didn't minimize your risk. You didn't take partials, and you took that loss, right? So this is a very mechanical way of trading, And there's nothing wrong with that. But the more mechanical it is, the more void of emotions you have to be. And you just have to have a model that you've actually tried and tested many, 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 many times. Because you don't want to be wasting your time using such a mechanical strategy that you haven't thoroughly tested. You don't want to be down the road, 5 years later, realizing, oh, it's not it's not really a profitable model. You would have wasted your time. So a lot of testing, back testing, and journaling is required. So you can see here in this, entire consolidation. Let's say that spanned about 2 days, and you can imagine being in front of the charts. We can use the replay tool. Where is that? So here, regardless of what type of strategy or concepts, um, it's just not viable to have such high R trades. You can't decide when the market's going to move, right? You can't decide like, oh, this is the reversal point. I got in here. Great. Put my stop there. I'm going to target these highs. 10 RR. You see price moving, doing nothing. Um, at this point, price drops very fast. If you went from the charts, you may have got scared and come out your trade. Or maybe you're very disciplined and you just follow the mechanical rules and you leave your trade. You don't even look. Price is doing nothing. Perhaps you're even bored. You see it trending up. You're like, yay. It starts to come down a bit, and basically it's stuck in this range, right? You see it going up. Let's fast forward because it's taking too long. Okay, yeah, it consolidates all the way here, and then it just drops and stops you out. If you didn't take partials, that would have been sad, because even above this high, that's 5 RR, taking partials even at 1 RR is decent. It's always good to take something off the table. But you can see how you would have lost that trade. How difficult it is to just say, I want to catch a 10 RR trade. Because how many of those would you have been able to take? 1 to 25 RR, 1 to 50 RR. Let's just put it there. Let's try 1 to 25 RR. Possible here. You would have had to catch that drop, and you would have to catch that top. Now, who's able to do that? Consistently. And how consistently and how often do these moves appear in the market? Let's look over here. There's none here. You couldn't have taken any here. You couldn't have taken any here. Here. For the entire month, there would have been no trades. And you would have been forcing something that would have never worked out at all. You would have taken 100% losses if your minimum RR was that high. How about a 1 to 5? Even so, not so often, is it? Oops. You'd say, yeah, I could have gone to a lower time frame. But then you're dealing with more spread, right? It'll still be the same thing. It's not, and you'll be dealing with more spread as well. Which, if you go down to 1 minute, your RR could be cut in half just because of spread. Maybe here, if you caught this bottom and you caught that top, okay, 1 to 5. A 1 to 10 would still have not been possible. Yeah. So basically, my point is, the market has to give you the opportunities, and you have to remain flexible and be able to adapt. I think that having just a fixed RR does not work all the time, because you may be missing relatively decent moves if you're not catching the trade, right? Or if you only have a rule where I'm only going to take profit at so and so RR. So something even something like a 1 RR, you could have caught many trades, right? So it doesn't really matter too much. If your win rate is low, then either you have to get more experience, refine your strategy, but most importantly, as a trader, you have to be patient. You have to be disciplined and wait for your setup to appear. And sometimes, the market may not give you anything for a long, long, long time. For example, this consolidation only ranges, okay, a decent amount of pips, but price is fractal compared to trending moves. This is quite a bit of a consolidation. Oops. Let's go back to here on, what was it, the daily? Yeah. So yeah, I hope that helped at least somebody better understand RRs. Okay. Again, it really depends on your personality, and it's something you can grow over time. I used to be more interested in the lower time frames, but now I'm getting more comfortable with the higher time frames, and then catching moves on the slightly lower time frame. Like I'll go is the 4 hour to find my direction, and the minimum I'll go is the 5 minute, normally the 15 minute, to confirm my trade and get in there. Understanding the odds of price, the market giving you trades that fit your RR, your fixed RR, decreases the higher your minimum RR is. That's why it's good to remain flexible. It's good to take profit. It's good to manage your risk and manage your trade. So you always end up with money. You don't leave money behind. There's nothing worse than being up a few $1,000s and then just being stopped out because you didn't want to take anything off the table because you were greedy, or because it didn't hit your preferred RR of 5 risk to reward. And you have to have patience and effort, right? So, the higher RR trade you want to take, it takes patience and effort. And when I want to catch large swing trades as well, it also takes patience and effort. So while I'll be maybe waiting on the daily, for example, to take a long, maybe price comes down here. I go down to the 4 hour. When price comes here, I got my alert set. That's when I'm looking for a trade. I believe this happened very quickly because of FOMC news. But I'd wait, and then I'd get into a trade once I get a confirmation, right? So it always takes patience and effort, especially if you have a trade setup that you think may yield a lot of pips. And before, again, flexibility and adaptation, always remain flexible and adapt to the market. Okay, because the market changes as well. Different seasons, different times of the year, different times of the day. The market changes, and you change as well. So it's always good to remain flexible and be able to adapt. Because creatures that don't adapt, they often die, right? They often get extinct. So yeah, that's all I have to say. Good luck in your trading journey. If you have any questions on anything, I'd be glad to help out. I like to help out people, and I'm open to coaching anyone who needs help, either psychologically or analytically, if they're into ICT's concepts of technical analysis. All right, thank you. Bye.